Hello, everyone. I'm Nicolas Bornozis, I'm President of Capital Link, and I would like to welcome you to today's webinar. It is our pleasure to welcome Mr. Carlos Balestra di Mottola, the CEO of Amico International Shipping. Before we begin, please let me go through the usual disclaimer that this discussion is only for informational and educational purposes, and it should not be considered as investment advice or an offer to buy and sell securities. And as an additional disclosure, Capital Link is very proud to serve as investor relations advisor to Amico International Shipping. Amico International Shipping is a major product tanker company, and its vessels carry typically refined petroleum products, chemicals, and vegetable oils. And the current fleet size is 31 ships. The Amico International Shipping stock trades on the Euronext Star in Milan under the symbol DIS, and on the OTCQX exchange in New York under the symbol DMCOF. Carlos, thank you for joining us today. It's a great time to have this webinar given the strength in the tanker market. We appreciate your taking the time to talk to us and share your insight on key developments in the product tanker market and the overall market trends. Now, let me start with the first question. We have seen mid-sized tankers perform really well over the past few years, and now it looks like larger crude carriers are starting to pick up. Freight rates for VLCCs have surged to their highest level in more than 2 years. So from your perspective, what does this shift mean for product tankers, and how do you expect the market to evolve from here?
Yes, good afternoon, Nicolas, and thank you for having me in this webinar. No, you raise a very important point here. VLCCs have relatively underperformed during the last few years, which have been very good for most tanker segments. But it was expected that they were going to come back. And the fundamentals looked very attractive at the beginning of this year. Only 7 VLCCs scheduled to be delivered, and potentially a good pickup in demand, which at the beginning of the year was supposed to come mostly from an increase in non-OPEC production. But then we also had an accelerated schedule of re-emission into the market of previous cutbacks from OPEC, which meant oil supply this year is now expected to increase by 2.7 million barrels per day. So it is a very pronounced increase in oil supply. And that is the main factor which has been driving the strength in the VLCC market. Next year also looks good, another just over 2 million barrels per day increase on oil supply anticipated for next year. So this actually, the other positive aspect here is that production is increasing, especially the non-OPEC increase in locations which are contributing significantly to ton miles. So a lot of the increases in the Americas, and a lot of this oil is then being exported to Asia. So a lot is coming from Brazil, also from Argentina, Guyana now, of course, the US, which has been an important contributor in the last few years. We have been seeing that China has been building up stocks, and that has supported the market so far. Reducing what would have been probably an oversupplied market already by now. So we still have the forward curve for oil prices, which are at the front end of the curve in backwardation, possibly thanks to this additional demand from China, which has been building stocks. But the strong crude markets should then influence also the product markets. That's the expectation. It's difficult for the opposite to happen, for a strong product market to drive the crude markets, because of the relative size of the two markets. The non-coated tanker market is 2.5 times bigger than the coated tanker market, and the VLs represent 60% of the non-coated tanker. So the strength in the VLs will positively affect the mid-sized tankers, and will also flow through to the coated tankers. And that is what we have seen in the past, and that is what we expect to see now. One of the main transmission mechanisms, of course, is the LR2 sector. Currently, we have 59% of the LR2s which are trading clean. But in the past, this has been as low as 54%, and there's no reason why this couldn't go even lower. So there's ample scope for more LR2s to move into dirty trades. There is scope for less cannibalization that we have seen. VLs and Suezmaxes transporting clean petroleum products. It was very pronounced last year, but this happened also this year. So the expectation is that the markets also for product tankers will be good. And a lot of this crude that is being transported will then be refined, right? And then after it is refined, it will be transported on product tankers. So the fact that we have already a strong product tanker market today, I think is a very good sign, because there is potential for further strengthening going forward.
Carlos, thank you very much. That was an excellent reply. And it's very important that you described so well the correlation between the crude market and the product tanker market. So a strong crude market means a strong product tanker market, and also it means less cannibalization between the two. So thank you for describing that. So summing it up, with crude exports ramping up again, especially out of the Middle East and elsewhere, and fleet growth staying fairly limited, that creates a supportive backdrop for product tankers over the next couple of years. I don't know if you want to add anything to that. I mean, you've said it very well already.
Yeah, no, I think it does, of course, provide a supportive backdrop because of what we just mentioned. It must be said that China is investing on additional storage capacity, so that is going to be available by the end of 2026. So we have to see whether China wants to continue building stocks or not. That will play a role. Stocks in Europe and the US for both crude and products have been rising lately, but they're still below historical averages. So that creates headroom for stocks to rise more. It is estimated that there is around 700 million barrels of spare onshore capacity in China and the OECD countries. But after this is filled up, if we are in a very oversupplied market, which we seem likely to be confronting in the near future, then we are likely to start seeing also floating storage. So even before floating storage, this oversupplied market should be very positive for tankers, for crude tankers, for product tankers. But if we do start seeing floating storage, then that will remove vessels from active trading and will create an additional tightness in the market, which could make the market even stronger. So that is also an important factor to take into account. Of course, if we don't look at these factors, fleet growth across tankers next year should be around 3.4%. So that is not a negligible figure. That is assuming minimal demolition, because we expect to be in a strong market. So that is potentially a bit of a headwind market. But if we do look instead at fleet growth for the fleet which has less than 20 years, which is the fleet which is trading in the mainstream markets, then the fleet growth across all tankers is much more limited. So we are talking potentially of less than 1% fleet growth, because you have around 25 million deadweight tons that are turning 20 years next year, and you have around 31 million deadweight tons delivered. So even assuming zero demolition, that would imply a fleet growth for the sub-20 fleet of less than 1%. So that, coupled with the additional demand that the market should experience because of all this oil which is being injected into the market by OPEC and non-OPEC countries, should provide a very supportive environment for tankers generally.
Thank you, Carlos. So vessel values have stayed fairly firm, and this is not surprising given the strength of the market. So how does this resilience play into how does it make you think about fleet renewal and expansion?
Yeah, no, it is true that vessel values have been resilient recently. They did correct. They corrected from the peaks that we saw around the middle of last year. 10-year-old MR2, for example, is around 20%. The value of a 10-year-old MR2 is around 20% lower, and of a 5-year-old MR2 maybe around 15% lower. So, but we have seen since around June this year an uptick in values again, reflecting the improving freight rate environment that we have seen over the last few months, but also the improving market fundamentals because of some of the reasons we have mentioned, but also because of the geopolitical environment we are in, where there were some developments recently which have supported the market and should continue supporting the market in the next few years. So despite this, all this positivity, we are quite happy with the fleet we have right now. We are not looking to buy more secondhand tonnage, but things can change.
Of course. So let me go to the next question. Now, we are in a stage of the tanker market where balance sheets are stronger and earnings visibility has improved. So how are you thinking about capital discipline in this environment? Is the priority more on consolidation opportunities, returning cash to shareholders, or building additional resilience for when the market cycle eventually shifts?
Yeah, we are not big believers in consolidation. With the fleet size we have today, we are able to manage our vessels quite efficiently and justify the presence we have across different geographies, which allows us to cover the market quite well. And I think the performance of our vessels on the spot market are a testament to that. Nonetheless, in terms of rewarding shareholders, I think it is important when the markets are strong like they were in the last few years, that distributions are made, and our controlling shareholder is also very happy to receive more dividends. And therefore, since 2022, we have distributed cumulative dividends of almost $140 million, $137 million, and we have pursued share buybacks of around $17 million. So we have been increasingly generous, I would say. So out of the 24 results, we distributed dividends of $65 million, and our buybacks amounted to around $10 million. So as we delevered our balance sheet, we were able to distribute a higher portion of our profits to our shareholders. But we also think that being resilient and flexible to be able to benefit from a market downturn, we operate in an industry which is cyclical. So eventually downturns do happen despite the strong fundamentals we are benefiting from right now, is important. So we want to maintain a strong balance sheet. But we don't have a crystal ball. And we need to renew our fleet. We have a young fleet, but the fleet is aging. And so we decided last year to order 4 LR1s, which will be delivered to us in the second half of 2027. And the overall investment for these vessels is $235 million, of which 45 was already paid to the yard, and 190 will be paid before the vessel's delivery starting in the end of 2026.
Thank you. Carlos, as you mentioned, you returned a very good amount of dividends to your shareholders. You've also been active with share repurchases. So how do you balance between the two, dividends versus repurchases?
Yeah, it's a difficult one. For us, the liquidity of our shares is also important, and we have a controlling shareholder, which, if we exclude treasury shares, owns just over 63% of the listed entity, the Amico International Shipping. The controlling shareholder did sell a 5% stake last year, contributing to some additional liquidity in the shares, and we have seen a bit of an improvement in the trading liquidity of the shares. But despite the very big discount to NAV, we are not as aggressive as we could be on share buybacks, because we really don't want to reduce this liquidity further. And I think that in the future, our preference will continue being that of distributing dividends. But occasionally, we might be active also on the share buyback front.
Thank you. Now, let me turn to a very different topic. Geopolitics, sanctions, and safety concerns have been main issues impacting the market. So share your insight, please, on how do you see these issues affecting the market?
Yeah, no, geopolitics has played a crucial role over the last few years in the market. The main factor, of course, and the first one to have affected the market positively was the war in Ukraine, and how that changed trade flows, contributing to an increase in ton miles, which we estimate to be of around 7%. But of course, also what happened in the Bab el-Mandeb Strait did play a role, especially in the first half of last year. There was a positive effect. Sailing through Cape of Good Hope is substantially longer than sailing through Suez, and a large portion of product flows did sail through Suez before these disruptions started at the beginning of 2024, end of 2023. So in the beginning, refining margins were very high, and there was a lot of product which moved on this longer route around Cape of Good Hope. So it contributed to a big increase in ton miles, and we saw a spectacular market in the first half of last year. Then the market in some locations was a bit oversupplied. There was a substantial drop in refining margins, and the arbitrages closed. It was not convenient, attractive anymore to transport refined products on this longer route which of course it's more expensive to transport on this longer route. So what we saw was when products did move on this route, they tended to move on non-coated tankers, which offer more economies of scale. So arbitrages were open to transport on these vessels, but they were not open to transport on the product tankers usually. So what we saw was that overall ton miles on this route, east to west route, actually went down in the second half of last year and beginning of this year. So I would actually say that it ended up being a negative factor in the second half of last year. And the product that did move, a large portion moved on uncoated tankers, mostly Suezmaxes, but also VLCCs. Over the summer, we saw refining margins improve again. And so that created a more positive environment, and we started seeing more product tankers sailing again, especially LR2s on this longer route. And that was one of the factors which contributed to the stronger markets we have seen this summer, improving markets relative to the first half of the year. So sanctions should continue playing also a very important role. They usually lead to a reduction in productivity of the vessels targeted. And today, I would say around 15% of the tanker fleet in deadweight terms, it has been already targeted by sanctions, whether sanctions from the US, from the EU, or the UK. So that is a very substantial amount. In certain segments like Afras and Suezmaxes, it's as high as 34% and 16% of the fleet which has been sanctioned. As I mentioned, the productivity of these vessels falls after they are sanctioned, but in the future, it could fall even more because now we are starting to talk about secondary sanctions and countries adopting stricter measures to prevent such vessels calling their ports. So, and in addition to that, what we are likely to see is that the diplomatic solution for the war in Ukraine seems very, very complicated. And at the same time, we are seeing that public finances, especially of certain European countries, but also in the US, are being strained for different reasons, but also because of the additional expenses of backing Ukraine in this conflict. And so there is political pressure back home for a solution to be found to this conflict. The diplomatic route, as I mentioned, is extremely complicated. Therefore, possibly the solution that will be sought, and given the recent decision, that seems to be the route which both the US and Europe are likely to be following in the near future. We are going to be seeing even tougher sanctions on Russia. There is a headroom which is now available because of this surplus oil production to be even tougher on Russia. Also on the oil front, of course, they're going to be tougher also on the LNG front. And also there is a close alignment apparently between the US and Saudi Arabia, which allows possibly a better coordination, and is probably one of the reasons which is behind this push by OPEC to increase production, which is which then creates room for additional tougher sanctions to be imposed and for the market to be able to absorb lower production from Russia without creating a spike in oil prices, which would be detrimental to Western economies. So in addition to that, we are also seeing more strikes by Ukraine on critical export infrastructure, oil infrastructure of Russia. So all of that has been hampering Russian exports of oil generally and should continue hampering even more in the future. So that is also supporting and should continue being supportive for the market, boosting the demand for non-sanctioned vessels. Finally, if that was not enough, there is also the Iranian situation, which is also a very complicated situation, and where there is room, a lot of room for stricter enforcement of sanctions. And it is likely that measures are going to be taken in that respect, reducing Iranian exports and once again creating more room for non-sanctioned barrels in the market.
Thank you, Carlos. That has been a very detailed answer. Thank you very much. Now, let me ask you, you mentioned that 15% of the existing fleet has been sanctioned. At the same time, we hear that the dark fleet is a very large percent of the, almost 20% I heard is in the dark fleet. So what does this mean for the tanker market? The combination of sanctions.
It is an issue. Yeah, exactly. It depends how you define the dark fleet, because there are different shades of gray here. But I also heard this figure of 20%. And it is a big issue, not only an economic issue, but more importantly, it is an important navigational hazard. We have seen a few important collisions involving these vessels, which are adopting malicious practices to conceal their identity, like spoofing and jamming. These vessels are usually using second, third-tier registries. They manage to much lower standards than the rest of the tanker fleet, and possibly also insured by less solid insurance companies. So they pose a huge risk to the environment and to the safety of their crews, but also of other vessels. So something must be done about this, and it would be important for more countries to take a tougher stance against these vessels, as for example was taken recently by the Adani Group in India, which accounts for around 80% of India's total crude imports, and which will not allow these vessels to call its ports. So these sanctioned vessels. So we need more such measures. They might possibly come as a result of pressure by the US and EU governments, but it is important that it does happen and that these vessels are further penalized, so that hopefully it will accelerate their demolition.
Thank you. Carlos, with the market being so strong as it is now, how do you deploy your fleet? Spot versus charter?
Yeah, well, we have had quite a prudent strategy, I would say, with a good level of contract coverage. We are now 53% covered for Q4 at just under $24,000 per day, 23,800 to be precise. And for 26, we have around 23% coverage at a slightly higher average rate of 24,600. So we do have quite a lot of spot exposure still for 26. We will look for opportunities to increase coverage, but for the reasons we mentioned, I mean, we are not in a hurry to do so, because we are quite positive for the market over the next few quarters. And we are confident we will find some attractive windows on which to take more coverage at attractive rates.
Thank you. Carlos, you have been speaking a lot about the modernity and competitiveness of your ships. Can you take us through the initiatives we have implemented to improve their efficiency and modernity?
Yeah, we have been retrofitting energy savings devices on our vessels. We have favored solutions which offer a fast payback period. Usually, they also entail limited investments, and the savings are, however, substantial. Propeller boss cap fins, press wheel vanes, wave equalizing ducts, but also operational measures such as biofuel risk management and propeller cleaning, amongst many others. So it is of an important focus for us. And of course, we count on making our fleet more efficient also through the vessels we ordered, the 4 LR1s we ordered, that will be delivered to us in the second half of 2027.
Thank you. Now, let's close our discussion with fleet expansion. You have, I think you have 2 remaining options which are already in the money. Are you likely to exercise them? Do you have any other plans for fleet expansion, second-hand vessels or new builds or?
Yeah, we do have some options on the money on vessels which are currently leased, bareboat chartered by us, which we are likely to exercise. These are financing arrangements. That's the way we see them. So we're not in a hurry to exercise them. We are already technically managing the vessels.
Right.
We have purchase obligations at the end of these contracts, but they are very far away. And so they are attractive financing arrangements. But of course, if interest rates do start coming down, as looks likely to be the case now, then it might be attractive for us to exercise these options, possibly sometime next year. And so they will be added to our own tonnage. We also are looking to sell. We do have a few conventional vessels, non-eco vessels, still on our fleet. We sold a 2010 built vessel last year, 2 2011 built MR2s this year. One was delivered to the new owners in July. Another one is going to be delivered in Q4. We still have another 2011 built vessel in our fleet, and 2 2012 built vessels. We are not in a hurry to sell these vessels. The 2011 built vessel we are likely to sell in the coming quarters if we find the right opportunity, and the 2012 built vessels in the coming two years, possibly. So we are quite happy to continue operating them. For now, they are generating substantial amount of profits for us at these rates. But of course, we are also going to be modernizing our fleet through the disposal of these vessels, and which will then be replaced by new vessels, whether second-hand or new builds. We don't know yet. Of course, as I mentioned, we have the 4 LR1s already ordered, but we could be ordering more vessels, or we could be buying some young second-hand tonnage in the near future.
Thank you. Now, let's close our discussion. Obviously, we cannot afford not to mention the upcoming IMO regulations. We're now in the aftermath of the London International Shipping Week. A large part of the discussion during the week was exactly the IMO regulations to be decided in October. So we've heard the IMO being very committed to proceed, to go ahead. On the other hand, we've heard some industry voices and groups, with a number of concerns. So would you like to share any insight or opinion on these regulations coming up, and how are they likely to affect the industry?
Yeah, no, they are going to be voted, I believe, around the middle of October. And despite US pressure and some important ship owners' pressure against it, the expectation is that it will pass. And the measures are focused on the greenhouse gas intensity of the fuel. So it's similar to the fuel EU, but it is more stringent. First year of implementation is 2028, and it gets more stringent than over time. It is going to be very impactful, and therefore it should spur the adoption of greener fuels. Now, here the problem is, and it's probably one of the reasons there is some negativity around these proposals. Some of these supposedly greener fuels, especially for tramp trading vessels, are going to be very difficult to find for many years still. I'm talking about green methanol and green ammonia. So they are not going to be viable solutions, possibly still for many years for the tanker industry. We think biofuels could play a role, but also other solutions such as wind-assisted propulsion. The technologies available today are not going to make a huge difference, but they are going to contribute to a reduction in the greenhouse gas intensity of the fuels. And we are looking at these solutions for the other ones we ordered. We are now, we have asked an external consultant for a study in this respect. So we don't have the conclusions yet, but our expectation is that if the proposals are approved in October as initially proposed, then it will be viable and attractive to install wind-assisted propulsion on our LR1s, even without taking into account the reward factors, which will be in theory available for fuels which are zero emissions or near zero emissions, and which we will only know these reward factors much later, possibly around the beginning of 27. So yeah, we are spectators here in the sense that we have to see what happens, but of course we will react to the regulations accordingly. And if it is approved as initially proposed, then it should drive at least the adoption of certain technologies which will reduce the greenhouse gas intensity of the vessels, of the fuels, sorry.
Carlos, thank you very much. It's been a very insightful, as always, discussion with you. So thank you for being with us today. So let me conclude by saying that this interview will be available on demand on capitallinkwebinars.com and on our YouTube channel. And again, thank you, Carlos, for being with us today.
Thank you, Nicolas.